Cela fonctionne. So I think we can start. Yes? Okay. So thank you for joining this parallel session on portfolio management. That I have the pleasure to share. We're going to have 4 papers indeed, not 3. But I think the printed program is consistent with this. So we're going to have a first paper by Arthur Thomas, then it's going to be Adil reading Something Goes. Both of them will be discussed by Laurence Carassus from Central Supélec. And then we're going to have a paper by Mr. Martin Arnaiz Iglesias and then Nicolas Baradel. And both papers will be discussed by Thomas Raffino. We're going to have the discussion just after the presentation. So it's going to be 20 minutes for each paper. 7 minutes for the discussion and 1 or 2 minutes for question in the audience. So I think with that we can start with Arthur. Does someone can start projecting the presentation? Yes, that's good. This mic is functioning. And I'll let you know when you have 2 minutes left, right? Okay, thank you.
Okay, thank you very much for having me to the program. I'm very happy to present here. So, a short disclaimer, we are 4 on the paper, 4 econometricians, no finance guy. So I'm very happy to have a comment about the more financial aspect of this paper. And the other disclaimer is this paper is an ongoing work, so yeah, don't hesitate to interrupt me. So I will start by a quick motivation of this paper. So here is the price of Brent, and I'm going to focus on which is called a bubble, where defined as time series bubble, where you have a shocks, and before the shocks you have an increasing following by a burst. Okay, and after you have a collapse. So I just give you another motivation. Here is the price of coffee, and you see there is a lot of bubbles. So the literature is focusing on 3 aspects of this bubble, which is defined as fundamental bubble by the economic literature. We have, and it's the market application of that is this increasing following by this collapse, and it's defined as rational deviation from fundamental values. However, we find a lot of, there is some techniques to detect the bubble on the markets. There is also some papers that try to explain how the bubble generates on the markets. And there is also some paper on the literature to see if you have a bubble, what is the economic implication of that. But what is very interesting is there is, to my knowledge, a very scarce literature on how to perform a portfolio allocation where you have an underlying asset that generates this kind of behavior, increasing, following by a burst. So, and this for 2 main reasons. The first one is as far as I know, most of the financial asset or asset manager use standard Markowitz portfolio allocation, which is based on unconditional moment of order 1 and of order 2, expectation and standard deviation. And when you have a bubble, and it is well known in the market that the market returns are non-Gaussian, and particularly when you have assets that generate this bubble, the unconditional moment in some cases does not exist, which means that the standard deviations that you calculate make no sense, okay? Because you underestimate the tail of your process. So our question is, okay, how we can propose a portfolio allocation to try to take this not Gaussianity that we found in the data. And what is also interesting is the standard econometrics approach that are available in the literature, which is well known in time series as ARMA or Garch models, are not able to replicate this kind of behavior. Okay? So basically, what we propose in these literatures is a new portfolio allocation based on recent, I said, standard econometric time series approach, which is known as mixed causal, non-causal modelization with alpha stable law. I have a slide later on to explain what is the mixed causal, non-causal model, but the main idea, and also what is a stable error distribution. Basically, a stable error distribution is all the laws that you know except the t-distribution, okay? And it's come from the Cauchy distribution to the Gaussian distribution. Okay, and we show that we need to take higher order and conditional moment because we have proof that this moment exists and you can use it. When I say higher order moment is not only the first moment, expectation, standard deviation, but also skewness and kurtosis. But it will be conditional skewness and conditional kurtosis. And how we use that? Basically, we derive the conditional predictive distribution of an asset where you are in a bubble, and you use that to plug into an optimization portfolio based on utility function. Okay, how we do that? Okay, let me start by explaining our portfolio allocation. So here I know it will be a little shocks, but we have only two assets in the paper. One which is generating some bubbles, which is XT. We call it risky asset. And one it's safe asset. Okay, in the application, risky asset should be a commodity, and think of safe asset as risk-free rate or something like that. Okay. So what we do, basically, we try to ride the bubble. So the main idea is you are time t, you give you an horizon of investment, h, let's say 1 year, for example, if you are in monthly, or 6 months if you are weekly, or 1 week if you are in daily. And the aim is to invest in some weight in the risky asset during some times, and after you rebalance everything in the safe asset, okay, until the end of the period. The main idea is how to get this H and how to get this weight. The idea is to ride the bubble, okay? So H is the most likely spike of your bubble, and you want to rebalance in that case. Okay. We can also short the bubble. Short selling is allowing. Okay, how we do that? So basically, we use terminal wealth until H. H is your investment horizon, and you can write that as depending on the safe asset and the risk asset. Okay, XT plus H and XT plus and RT, which is the return of the safe asset and the return of the risky assets. Okay. Okay, so you have that, and if you use the standard utility Taylor expansion of the CRRA or CARA or utility function, you can explain that as something which is a terminal wealth conditionally to XT, the price of today of the risky asset, and ST, the price of the safe asset today. Okay, and by using linear algebra, it only matters of XT plus H power P. P is 1, 2, 3, or 4. Expectation, standard deviation, skewness, or kurtosis. Okay, up to H and conditionally to that. But the main reason, idea behind is, okay, XT, we know that is making some bubbles, and how to get this value of this conditional distribution, conditional to be XT, how to get XT plus H, how to get the H, that the point that the horizon that the bubble are more likely to crash. Okay, I said it's an ongoing work because here, if you understand the framework that we try to use, is to use, we target more, in a sense, risk investors because you want to ride a bubble, okay? So it's designed for extreme events on the market. It's designed for bubble. And if you use CRRA utility function, what you use is basically a Taylor expansion for small returns, okay, around 0. So there is a risk, you need to use that for extreme risk, and you can use Lyra utility function from Gouriero and Montfort 2013 to take into account that. Okay, so maybe I need to take a little bit of, increase my presentation. Okay, so how I get this distribution, predictive distribution density of these bubble assets? It's relying on mixed causal, non-causal time series model, and most of the time when I present this in the standard economic department or something like that, people look at me very strange, okay? So the idea is that, I don't know if you are very familiar with the standard AR1 process, which is XT depend on XT minus 1, which is the standard path that you have, the bubble decay. Here, it's an econometric framework that at the beginning was very parsimonious to capture this kind of behavior, increasing following variables. The idea of the people that developed that is come back from Rosenblatt in the late 90s, is to switch the time series in the other way, so condition to the futures and not to the past, and it gives you this kind of behavior. See, this is the impulse function response. So if xt depends on the future of xt, and xt depends also on the past of xt. Okay, you flip the time series in the other way. It's very parsimonious to capture non-linear framework and something like that. If you want to capture this kind of stuff, you need to sometimes, for econometry, to include Markov switching or Garch modelization or a lot of kind of stuff, but it's very easy. If you flip the time series, it's only an AR1. Okay? So the main idea is your time series depend on future shocks. And this is the impulse function response that you get. You have the shocks that are materialized. You have an increasing by the coefficient which is in front of the bubble growth. So this is the growth rate. The shock happened, and after you decrease by the causal, which is called causal rate, or the bubble decay. Okay? Here I plot you some trajectories of these processes with epsilon t is here alpha stable. Why is alpha stable? Because you need to be non-Gaussian to be able to identify the part that is causal and the one that is non-causal. If you use Gaussian time series, you are not able to disentangle the part that is conditional to the past and the part that is conditional to the futures. Okay, but we use alpha stable law. So as I say, all the alpha stable laws that all the laws that you know, it's alpha stable except the t distribution. It means stable by additivity. If you take x1, which is stable, x2 is stable, any linear combination of x1 and x2 is stable. Okay. And it's dependent on 4 parameters. The one that is more interesting is the alpha. Alpha is the tail of your process. If alpha equal to 1, only the standard, the expectation exists. If alpha equal to 3, you have the skewness, and alpha equal to 2, it's a Gaussian distribution. Okay, so it generates this kind of tail behavior. Okay, so the idea is like if epsilon t is alpha stable, xt is alpha stable. So xt plus h is also alpha stable. And we have like conditional distribution, the vector of xt plus h, xt is the price of today, xt plus h is the price that you want to forecast, is alpha stable. And we have some closed form formula to get the conditional density of this process, xt plus h. Okay? So don't be afraid. This is the conditional moment that we get up to order 4. Conditional to xt. This is the value of the parameters, so it's like very complicated. We can express all of this depending on these parameters, which is only, but if you look at it, depends only on 2 things. The causal part, so the growth of, the decrease of the bubble part, the increasing of the bubble part, okay? Your forecasting horizon, P, it's the moment, order of moment, and alpha, which is the tail parameters. So it's afraid, it's very complicated formula, but let me show you how it's, if you summarize that, it's very simple at the end, is that. So the result that we get is basically at time t, it's the same behavior as the Bernoulli law, okay? But we are able to calculate the probability to continue to growth, which is the bubble growth rate, powers the tail of your process, or you have a probability 1 minus that to crash, okay? And at each step, you can have this kind of behavior. That is the demonstration that we get, these complicated formulas that we get. So this solves my issue because I am able to explain this conditional moment up till h for xt, for the standard deviation, for the skewness, for the kurtosis. And I can plug in, because I have closed form formula, in my utility function and obtain the weight omega and h and perform my portfolio allocation. Okay, so basically that we did some Monte Carlo simulation, but I only present the empirical application here. So what we did, here we take the price of CO2, the price of Brent, and most of the commodity where you have some bubble. We have an in-sample period when you calibrate this non-causal mixed causal model by maximum likelihood. You get the parameter of the bubble growth, bubble rate, the tail of your process. At this step, you have these parameters. You can plug in into your optimization portfolio. It gives you the amount that you need to invest up till h. H is the probability of crash. You invest that, and after, on the out of sample, we do a backtest and compare some performance metrics of portfolio. Okay, so I skip this part because we need to, as I said, our processes is a fundamental part and plus a bubble part, which is a MAR 1.1. Here I'm an econometrician and not a smart guy and not a finance guy. What I call fundamental is basically detrended. Okay, I have some robustness on that later. I will explain. Okay, and so the parameters that you get for the CO2, for the Brent, and for the WTI give you here the growth rate of your bubble, the tail parameters, and the decrease of these parameters. Okay, I don't know how many time I have. Okay, I have plenty of time. I can slow down a little bit. Okay, perfect. So yeah. Okay. So when we get these parameters, the growth rate, the tail, and so on, you can compute this conditional predictive density up to xt plus h. And it gives you, for each quantile of the distribution, you could have some multiplier equilibria. I will explain why you can have some multiplier equilibrium of your decision investment. Okay, so conditional to xt, the only decision that you take is conditional to xt. Okay, so the price of the risky asset today. So what is matter is the distribution of this price, xt. Okay, so that's why in this table I present xt when xt is over the quantile, the median, over the up to over the quantile 9.5, 9.999, and so on. So how far you are from the central value, how far you are in the bubble. Okay, and depending on that, because we have this, you have different equilibriums that you get. Okay, so here you have W star. W star is the amount that you put in the risky asset. Okay, H, 8 stars, is the time according to this conditional distribution that you have to rebalance. Okay, and to invest all the rest in the safe asset during the end of the period. And what we happen in the simulation Monte Carlo, and we found that is, look, if you are in the, let's say, middle distribution, so between the quantile 0.5 and let's say 0.8, you have multiple equilibrium possible that give you the same utility function at the end of the investment period. One is invest in the safe asset, but with a small horizon, or invest in the risky asset with a short horizon. Another one is short the bubble with a long horizon of investment, okay? Or do nothing. So 0.4 sometimes is do nothing, okay? But when you go to the top of the distribution, so close to the higher quantile, look what happened. It says short the bubble, short the bubble, short the bubble. So it means when you are far from the distribution, and when you are close to the top quantile of the distribution, so you are ready to burst, you are close to this distribution, our optimal portfolio allocation say short the bubble. Okay? In the middle, it gives you two possibilities. You can invest but in the bubble but short horizon, or short the bubble with longer horizon. Okay. Okay, so what we do, so I said we calibrate all the parameters in the in-sample, and after for the out-of-sample period, each day we place this strategy, okay, until horizon H, and we do some backtest each step of each step. Okay, until horizon H. So basically what we try to do here is to write this big bubble in that case. Okay, so basically we do that every day, and get the out-of-sample analysis. Okay, I forgot to say something. Maybe I can go back really quickly. Okay, if you follow me, okay, it's here. Okay, if you follow me, the main issue with that is we ride only one bubble. Okay, because if I reach this H star, which is the most likely that the bubble crash, I rebalance everything in the safe asset until the horizon. So if you have one big bubble, it's work because you get the peak of the bubble and after you do nothing. But sometimes, for example, for asset manager, I think it will look strange that I said during 6 months you invest only one times and you rebalance only one times. Okay, that's what I said. Okay, compared to the decision that I take is only based on the XT where I am in the conditional distribution on time t. Okay, so it's a bit strange. So that's why we allow the algorithm to do that multiple times. So basically what we do, we write the bubble, H, we close our position, and when we are close the position, we allow the algorithm to take another decision investment until you reach H, okay? But because you have multiple equilibrium, okay, what I can do? You have a kind of growing tree, okay, that's happened until you reach your horizon. Here is 26 weeks, for example, because it's on weekly data. So it's say, okay, conditional to xt, today, we will short in 5 days, 5 weeks, sorry, the bubble with an investment of 0.5. You calculate the weight that you get at some point, and after you do conditionally to that, okay, again. Okay, so we do that, and we compare our strategy in compared to the standard benchmark in the literature, equally weighted and mean variance, where you only take into account unconditional moment of order 1 or order 2. And we compare with 2 or 3 indicators, terminal wells, opportunity cost based on the utility functions that you get, Sharpe ratio and modified Sharpe ratio. And this is the table. And for all the out of sample, using different measures of risky aversion for CO2, Brent, and WTI, we perform better than using only mean variance and equally weighted portfolio. In particular, when you are during extreme events. So, yeah, basically that's the main results of this table. If you are, this is the performance of equally weighted and mean variance in terms of terminal wells for the Brent, for example, and this BP, it's our bubble portfolio, I said, 90, 10, the 10 worst case and the 10 better case, because you have multiple equilibria at some point, so you have different trajectories that you can invest. So most of the time we are performed better than the one from equally weighted and mean variance. And we also, okay, it's the same result for opportunity cost, but we also perform in the paper when you are over some quantile, over 90%, the 90 quantile, it's performed better. Okay, so basically to sum up, we propose an asset allocation that accounts for specificities of bubble assets, relying on mixed causal, non-causal models. That is well known in the literature to capture this kind of bubble behavior. We compare in out of sample between equally weighted and mean variance, and we apply to Brent, WTI, and CO2. The extension that we investigate is using a larger portfolio that only one risky asset and one safe asset. And yeah, there is some ongoing work relating to the fact that we detrend it. And as far as I understand, what extension that we consider is a unit root plus a bubble assets. So thanks for your attention.
Thank you, Arthur.
Oh, sorry.
Still working? Yeah. So now the comment by Laurence Carassis from Central Supélec. Laurence?
Okay, so if you can put perhaps a slide, yeah, thank you. So I'm going to discuss the paper we just heard by Thomas. And so I start with the summary, which is quite similar to the conclusion just Thomas made. So here this paper examines how to optimally allocate it to portfolio, including an asset that exhibits bubble-like behavior. So here the bubble-like behavior is modeled thanks to a MAR11 mixed causal non-causal model. And there is portfolio optimization under not exactly a CAR utility function, but a 4-order Taylor expansion. And then there is some Monte Carlo simulation that you didn't show, but also it's part of the paper, and empirical data to compare this to other strategy like mean variance and 1/n. Okay, so for me the key contribution of the paper is to propose a multi-moment optimization approach to handle practically speculative assets. Even if there is only one, it's since an answer. So it provides empirical evidence on the benefits to use some bubbles in your portfolio allocation, and offer a new perspective from the people who work in bubble markets. So I just compare very quickly with the classical bubble literature. So the bubble definition here is using a MAR11. So there is, you show two kinds of literature, the rational expectation model, and here I will speak a bit about the strict local martingale model. Then the portfolio approach, here you use a very crystal clear maximization of expected utility, and you compare to another paper which use neural network model, where it's a bit more complicated to interpret the result. And then what is very nice here is the application on empirical data, and of course when I speak about strict local martingale, we are more on a very theoretical point of view. So as I say, the strength of the paper is to provide a practical quantitative framework for portfolio allocation, very nice empirical result, very deep, and to demonstrate also that your strategy performs better than other strategy. So possible extension, I think it would be nice to use other models than MAR11. Could be one possible extension. It could be tested also on other markets. So here you was on more on energy, so could be interesting to go to crypto or to technical asset to see how it performs. So from a more mass point of view, I know you give some quite convincing argument to say that X and S should be independent, but it could be nice to see what happens if they are. And the other thing, so you speak about your H star, the rebalancing date. It could be a stopping time. So it could be now some random variable depending of what happens. So of course you speak about considering more than one bubble assets. And okay, so now I would like to speak for a few seconds of this paper from Paolo Gausoni and Miklos Rajdoni. It's a very nice paper that it's not so well known, but which speak about the fragility of the bubbles. So if you are in the strict local martingale context, which means that you have a zero local drift, the term in dt is equal to 0, but then you have a global drift, which is hidden in the unbounded diffusion drift. So they show that in a diffusion model, if you have small transaction costs, the bubble disappear. So it's really showing quite general setup. So it shows that the bubble are fragile and disappear under small transaction costs. So the second thing I wanted to show is, I know it's not the same problem, but it's about the reliability of the Taylor expansion. So here it's a computation of a reservation price on an illiquid share. So in black, you have the price, the Monte Carlo price. It's as a function of the correlation. And then in the four red color are the Taylor expansion. So if you look the one moment, you cannot really see, but in fact the four are not so good. So it seems that here going to order 1, 2, and 4 doesn't give a very reliable approximation if the correlation is not very close to 1. So it's give me to this slide. So here I think it will be interesting to think about this duality between the diffusion model, the fragility of the bubble, and here the practical exploitation in your model. So would you have some, with the transaction cost, I know you have a part on transaction cost and you say it's not so good with transaction cost also, as far as I understand. So it could be an explanation, this paper from Gausoni and Razzoni. So I think it's also necessary to test more with transaction costs to see what happens. And also for the last things is to provide a sensitivity test with the moment of order 4. But in fact, it's just saying that you don't really use a CAR, but a 4-moment extension. So as a conclusion, I would say that it's an important contribution to the bubble literature, which propose an allocation based on conditional moment of returns. It complements and improves the approach because it combines non-causal model. It's really turned into application, numerical application, and I think it will be nice to think about this debate between theory and practice. So this theory of strict semi-martingale, and to see how the MAR evolves in this kind of problematic. Thank you.
You want to answer some of the question? Question?
Yes, thank you for your comments. Yeah, I agree for the submartingale. There is some conditions that the mixed causal non-causal model are submartingale. I think it's a paper in Jean-Michel and Christian in GRSS. So you have this kind of idea. And for the transaction cost, for my H, the H is stochastics because it's defined by the optimal portfolio allocation. And for the transaction cost, we think it's not matters in that case because we only rebalance with parsimony during the H. So we, in compared to, for example, adjust every day your weights in your mean portfolio allocation strategy, we invest only one or twice during this period because of this riding of the bubble. So I think the cost improve our approach than the one of because there is less transaction cost. Yeah. However, I think the reason that for moment of order 3 and 4, we also did a robustness with that in the paper, taking only conditional 1 and conditional 2 to see if it matters or not. You're right, it's not matters. It only matters when you are very, very far from the central distribution. And yeah, last strong, I agree with the transaction cost that kills the bubble. And I think you're right for high frequency trading or high frequency, because here we are, because of the reasons that we can take into account the unit route plus the MAR11, we are stuck with weekly data or monthly data. And in that case, it's not so important the fact that transaction cost kills the flash bubble or flash crash. So thanks.
I don't know if there is a question in the attendance. Okay, so we'll have another one later on, but we have to move on. Thank you very much, Arthur and Laurence, for this excellent presentation. So the next paper is by Adil Settingos, joint paper with Chalabert-Lehal. So Adil from University Paris 1. Thank you. Please come. Synthetic data for portfolio flow of the dice will never abolish chance, right? So
yes.
Good program.
Thank you.
So you have 20 minutes.
Okay.
And then Laurence will be back for another comment of 7.
Thank you. So, hello everyone. First of all, I would like to thank the organizer for this great event. I'm very happy to be here. Today I'll present you a joint work with Chalabert-Lehal from École Polytechnique, and I'll mainly focus on the difficulty of using the modern synthetic data generation tools in finance. So, as you may know, actually there has been quite some interest in finance in using the generative models that revolutionized the image generation, for example. And the idea is to use these models to simulate multivariate asset return time series, because there are numerous applications if we can do that. For example, we can construct or stress test portfolios based on these synthetic market scenarios, or we can try to optimize the hyperparameter of an investment strategy by backtesting this strategy based on these synthetic diverse scenarios, or we can be more ambitious and we can try to train an agent that learns how to behave optimally in a given environment, for example, using reinforcement learning. However, the question is if these models can be used off the shelf in finance, because we know they work pretty well for other applications like image video generation, but we are not sure if they can be effectively used in finance that easily, especially if we use these models off the shelf. So our answer to this question is probably not, because we have two main problems. First is specific to finance, or it might be specific to finance, and it's related to the amount of data that we have. We mostly have smaller data set in finance compared to these other domains where there are huge data sets. So this it might be an issue. The second issue is related to portfolio construction, and it's also related to the objective function or the loss function of these networks. The loss function we use to train these networks. Actually, there is a contradiction between the way these models learn and what we try to do in portfolio construction. So I'll go into detail about these 2 points, and then I'll try to propose a simple architecture that can help us to mitigate these problems. And at the end of the talk, I'll talk about how we can evaluate what we have generated using our model. Actually, this is not an easy question and not a trivial question, and the evaluation part is quite important. So, very briefly on generative models, the idea is to learn a function, g theta here, which is often a neural network, that can map a noise into something meaningful. And the way we learn the parameters of this neural network or the weight of this neural network is only using the available data, the training data that we have. So we try to start from a noise and map it to something we desire. In the case of images, it's realistic images. In the case of asset return time series, it will be a high-dimensional asset return time series where we capture the properties of asset return that we see. So actually, there are different ways of learning the weights of this function g and the weights of the neural network. From energy-based model to diffusion models, there's a great literature. And actually, this semester, Stéphane Mallat gave a great course at Collège de France about all these models and the mathematics behind. And they uploaded all the courses on YouTube. So if you are interested in the subject, please check these courses. It's pretty interesting. Now, the question is, and we know that, yes, with images, we achieved extremely good result, but the open question is if we can achieve similarly strong results for asset return time series. One big problem, as I mentioned, is the amount of data that we have. So financial data, of course, it depends on the application, but financial data sets are often limited in size. For example, if you want to simulate daily returns synthetically, 30 years of daily returns amounts to only about 7,500 observations. And actually, this is ridiculously small compared to these vast data sets, huge data sets that we have, where we have millions and millions of data. So this is one issue. The second issue is that we might have a bigger data set, but we might want to use only a small portion of this data due to non-stationarity. So even though we have a big data set of returns, let's say, we might want to keep only the last portion because we might believe that the last part reflects the current market environment. So these two issues actually exist in finance, and it's necessary to keep in mind that we train these models with small data set, if it's the case. And I'll assume that it's the case. But why is it a problem? The problem is because that we ultimately want to use to estimate a parameter theta, which is the ground truth for our population, but we'll fit a model using n points, where n is not that big. It means that our model will converge to somewhere where this parameter with respect to this model is represented by theta tilde n. So there will be a learning distance, which we call an, between the truth and the truth for the model. And what we do using these generative models, we simulate from our model and use a sample statistics, synthetic sample statistics, to estimate the truth. However, for example, if we simulate many points from our generative model, the variance of the sample statistics will shrink, and its distribution will peak around the truth for the model, leaving the real truth outside the distribution of the synthetic sample statistic. So actually, the classical way of using generative model is to train the model and forget about the training data and use it to sample many, many points do not work in finance, because it means that we will leave the true parameter, the true population parameter, outside the support of the distribution. So actually we tackle this question analytically in the paper, and we derive an error bound for the probability of the sample statistics be around the true parameter. And what we can see from this expression is that when we send n tilde, which is the number of synthetic data that we generate, goes to infinity, the probability of the sample statistic being b close to theta goes to 0. So actually, if we generate many, many points, we go to a biased conclusion. So the bias is unavoidable if we sample many, many points. So what we can do, if we want to use these models, we can use a rule of thumb from bootstrap literature. We can decide not to generate more than what we have at the beginning. So it might be a way to deal with this issue. Second issue I want to mention is more related to portfolio construction. And for that, let me remind you the basics of portfolio construction and why is it problematic to construct portfolio on synthetic data. So if you remember the classical framework of Markowitz, the idea is to maximize the expected return of the portfolio for a given level of risk measured by variance of the portfolio. And under this objective, we can write the optimal portfolio W star analytically, which actually involves the inverse of the covariance matrix. Actually, it's pretty standard that this covariance matrix is coming from a risk model or a statistical factor model, and we can write it as in the equation 1, which actually is formed by the first m eigenvector of an historical covariance matrix, let's say, and the first m eigenvalues, plus a constant eigenvalue. We replace the remaining eigenvalues with a constant to ensure that we preserve the trace of the original covariance matrix, original historical covariance matrix, and actually it can be a statistical factor model for our covariance matrix. So under this representation, we can actually inject this covariance matrix into our optimal portfolio, into our solution, and replace the inverse of the covariance matrix with this term. And when we do that, we'll see that the optimal portfolio is actually a linear combination of the first m eigenvector, scaled down by the associated, by the corresponding eigenvalue. What does it mean for portfolio applications and in finance is that we know most of the time we have a very big eigenvalue. The first eigenvalue is associated with the market and it's very big, and it will scale down the exposure to the market, for example in this case, to very low levels. And the impact of the remaining eigenvectors will be much higher. So there's an inverse relationship between the level of the eigenvalue and its impact on the final portfolio. So actually we can do a more interesting analysis to see what happens if we slightly move or if we slightly introduce an error to one of the eigenvectors, and we will see that the impact of making an error on an eigenvector associated with a small eigenvalue is much higher than making an error on an eigenvector associated with a higher eigenvalue. So we need to learn better, we need to learn well the eigenvectors associated with small eigenvalues, because they are more important for portfolio construction. However, this is not what generative models do. Actually, the objective of generative models is to minimize the distribution or a divergence or a distance between two distributions, the original data distribution and the synthetic data distribution. Actually, because of this objective, the model is attracted to high variance factors, which are less important for portfolio construction. For example, let me consider the GAN architecture, generative adversarial networks, and GANs actually minimize some sort of distance, precisely the Jensen-Shannon divergence, by solving the following min-max problem. So we simultaneously train a generator and a discriminator, and our discriminator actually assess the input, and it tries to assign a probability to the input if it's fake or not, and generator actually tries to fool the discriminator, and this is how we learn the optimal generator that can generate something which is close to the original data distribution. Or another idea can be to replace the max part of the max term in the optimization problem with the Wasserstein distance, because it has nicer properties than Jensen-Shannon divergence, and we can actually try to find a generator that can minimize the Wasserstein distance between the probable distribution of original data and the probable distribution of the synthetic data. Actually, there is one theorem in a paper from Feyzi and the co-authors, and they show that if we consider a very simple case actually, a linear generator, so our generator will be a linear function, so a neural network without an activation function, and a Gaussian settings where the original data is following a Gaussian distribution, they show that the optimal generator will generate synthetic data whose covariance matrix is formed by the first m eigenvectors and eigenvalues of the original covariance matrix. Here m is the dimension of the noise that we use to feed the generator. For example, we can use a univariate noise, and in that case, the covariance matrix of the synthetic data will actually be formed only by the first eigenvector of the original covariance and the first eigenvalue. But we know that in portfolio construction, we care less about the first eigenvector. So because it's our portfolio's exposure to this first factor is minimum. So actually, we want an architecture, or we want a model that learns well the following ones, the following eigenvectors, rather than the first one, let's say. So, and ironically, we learn best what is least important for portfolio construction. So, actually, we need to avoid this imposed hierarchy somehow, and what we propose, actually, to avoid this is to map the initial returns to a space of orthogonal factors and learn the factor returns, or learn in the space of these orthogonal factors. So what we do is that we map the initial multivariate asset returns to a space of orthogonal factors. We cluster the similar factors in the same clusters and learn one generative model for each cluster. And then we generate synthetic factor returns from each cluster and then map it back to the original data space. And by doing this, by learning each factor one by one, we ensure that we learn a factor which has low variance as well as a factor with high variance. We test our pipeline on S&P 500 data. So now I want to go to the question of evaluating what we have generated. So we use this architecture and try to learn what happens in S&P 500, and if we can generate synthetically in a realistic way this type of high-dimensional data. Now the question is how to evaluate what we have generated. So actually the first idea can be, an ambitious idea, is to evaluate all these, evaluate at the asset level. So to understand if we capture the properties at the asset level. But it's obvious that this kind of approach is not scalable, and it becomes impossible to verify for all the assets as the number of assets grows. Another idea can be to evaluate based on linear combinations. So we can consider a simple portfolio, let's say an equal weighted portfolio, and we can compute the returns of the equal weighted portfolio on the historical sample and on what we generated. And now the dimensionality, we reduce dimensionality from 500 to 1 because now we have two distributions to compare. So it might be an idea, and we can write lots of statistics of the equal weighted portfolio on the market generator and on in-sample and out-of-sample, and try to understand if we learn something that can generate realistic time series. However, we think that these kind of conventional tests are not enough because these models are mostly developed for much more sophisticated applications. For example, one application can be to analyze how the Sharpe ratio of a mean revergent strategy evolves with the look-back window length, let's say. So in this kind of applications, it becomes much more difficult to assess the suitability of the market generator because we can no longer trust to in-sample and out-of-sample estimates because we don't have much idea about the standard error of these statistics under the sophisticated applications. So actually what we propose, which can be interesting to check, is a test for identifiability. So what we mean by that is that, so we have a market generator, and we say let's simulate from this market generator n synthetic data points, where n is equal to the size of the initial data set. So now we take a second market generator and train the second market generator using this n synthetic data points. What we will try to do is to understand if the second market generator actually produce data that are valid at the level of the interest. What I mean by valid is that we try to capture the true properties of the first market generator by training a second market generator using only n synthetic points. So if the market generator cannot capture the underlying true properties of the first market generator, we can say that the first market generator had no chance to capture the true properties of the market because it cannot even learn from itself. If it's able to capture its own properties using this limited synthetic data points, we can further evaluate our model for further applications. So thank you for listening. And this is the paper that we recently put on archive. So if you are interested in, you can find it on archive. Thank you.
So the discussion is going to be done by Laurence Carassus from Central Supélec. I think you have your phone. For the next speaker, could you stay here? Because I was mentioned that if you can stay and look at the screen.
Okay.
Because otherwise it seems that the camera is only seen in the back.
Okay.
Thank you.
Oh, thank you. Now I will discuss the second paper that Adil just present. So first, something I didn't say is that the two papers have something in common. The two titles are very nice. Okay, so I start with a summary. I think it's quite nice because Adil really didn't speak a lot from the numerical side, which is quite important in the paper. So here the paper investigates the use of synthetic data in portfolio construction and risk management. So he highlights the challenge of using generative models in finance, particularly regarding the initial sample size and also taking into account the model objectives. He proposed a pipeline for generating synthetic data, financial data that respect the so-called stylized fact observed on the asset returns, and also is aligned with the intention of application of the model, of the data, sorry. So it evaluates also the last part, evaluates the effectiveness of synthetic data on a long-short strategy on portfolio optimization. So I think I will go quite short on this slide because it's more or less, the three first lines are more or less the same as the last slide. It just says that the generative model doesn't work so nicely in finance. And just for the last line, it introduces also a new evaluation method based on what is so-called identifiability in finance, so testing whether we can learn something of ourselves. Okay, so some comparison with the existing literature. So here the approach is really focused on the model limitation of the machine learning for portfolio application. And since the existing literature just focus on pure data models, so then here there is a notion of evaluation that I think is very interesting. With I tried to do it better the second time. Identifiability test for synthetic data, and also really directed by the intended application. And there is the part also on the bias between the theta tilde n and the real data. And in the literature, generally, one assumes that the more data you have, the better it is. The more you generate data, the better it is. And also the very nice part about the decomposition in principal component, and to show that the first one, which are really used in the traditional model, are not the more important for portfolio optimization. So the stylized fact from finance is that the financial data are noisy, they are non-stationary and high-dimensional. So it's difficult for GAN for this kind of model. As you say, there is a limited set of available data, and even the older ones are not so interesting because of a change of regime. And synthetic data does not always preserve important feature for portfolio optimization, like tail risk or the structuring factor. Okay, so this is the pipeline you propose. So first, a factor decomposition. So you extract the principal component from asset returns, and then you choose the M, the number of factor. This is the first 3 parameter. Then you take a temporal convolutional network, which captures the time dependency, and then you choose S, the memory. And then you do data augmentation after some clustering. So you group the similar data to improve the training, and then you make a correction on the variance using a mixture of two student law. And then you have this part about the evaluation through identifiability test. And so you check whether your synthetic data maintains portfolio relevance. And so you compare with sharp restore profile. So I think the paper is really very well documented. There is a large discussion of the literature. It's really centered about the critical flows for the GAN in finance, so I think it's also very interesting. It incorporates statistical structure into GAN, so I think it's also very interesting. And propose a rigorous evaluation to identify poor synthetic data models. This is really made for portfolio and also to backtest long-short strategy. So I just rewrite your n, so it's a tilde n. I was not able to find tilde on the thing. So if you think that an is quite small, then you could find an n so that it's lower than b, and then the probability that un minus beta is lower than b is equal to 1. So I just turn your inequality in the reverse direction, so you can also have another conclusion from this inequality. Then you find there is a rigorous way to estimate M, but I think it could be also interesting to try something else, because I guess that the sensibility to M could be quite important. And the same for S, to try something else. The other question was the computational complexity. Is it really feasible in a reasonable time, or what time does it take? So you have tests on the SP 500. It could be nice to see on other asset classes, and to see also the performance of the technique in high volatility or regime switching markets. So this is almost the same thing. So testing S and M, looking to other things that US stocks, bonds, crypto, or emerging market. You have test long, short, and long. So it could be nice also to test other strategy, and to study the impact of friction. So it was on the portfolio allocation, and yeah, it's the same thing. How long does it take to make all these things? So is it feasible in live markets? So conclusion, the paper make a major contribution by showing that generative models needs to be specially adapted to financial constraints to be exploitable in portfolio management. The paper raised critical concerns about synthetic data in finance, and especially in portfolio construction. It proposed a pipeline to improve the usual GAM and highlight the need for better evaluation metrics also beyond simple distribution similarity. Thank you.
Thank you very much, Laurence. So maybe Adil or Sharabe, you want to just answer? Or
Thank you very much for this great discussion. For the title, I need to give credit to Charles. He was the one who came up with the title. Actually, it's an English translation of a poem from Mallarmé. So, yes. And on the comments about the probability that can go to 1 if AN is less than B, this is indeed the case. However, actually, we don't believe if we don't introduce something structural to the model, it's almost impossible to get something close to the true parameter, because we can do that actually. This can be close to the true parameter though. So the parameter with respect to our model can actually be close to the true parameter if we have lots of data, or if we introduce something structural to the model. If it's not the case, I think it's not unreasonable to assume that this learning rate will be greater than B. But yes, if we have something close to the true parameter, this probability would go to 1, and we would want to generate many points from the model. On the training time, actually, as I said, and thank you for focusing on the numerical part as well, because in the presentation I wanted to focus on the challenges, and I didn't have time to go into detail about the architecture. So actually, to train each cluster, it takes like 20-25 minutes to train each GANs, and the simulation part, so the inference is quite fast. That's what I can say about the training time. And yeah, I don't know if you had one other question as well, but I don't think I have time. So thank you very much for the discussion. Thanks.
thank you very much, Adil. Question? Yep, please.
Yeah, just a quick comment on eigenvalues. I mean, it depends what you want to achieve. Whenever you want to consider the highest risk for a portfolio based on a given set of assets, then you will focus on the highest eigenvalues, because then you try to maximize the variance of your portfolio. On the other side, if you want to minimize the variance, I mean, basically when you want to optimize your portfolio, minimize the variance, then you will for sure concentrate on the lowest eigenvalues, but you may have other situations where you rather concentrate on the intermediate eigenvalues. So it depends really on what you want to achieve.
Yes, yes, exactly. That's why I consider this statistical factor model, where until mth factor, we think that these factors are important, and after m, we just replace the corresponding eigenvalue with something constant, and we said that they are based on noise. So, but yeah, as you say, it depends on the application. The case we considered was long-short portfolios, where we try to be orthogonal to these high variance factors, like the first ones and so on. But yes, thank you. Thank you for the comment.
Thank you very much, Adil. So we move now to the next presentation, Mara descent algorithm for risk budgeting portfolios. So here again, very good title. So by Martin Arnaiz Iglesias from Université Paris 1, Panthéon-Sorbonne, and that will be discussed by Thomas Raffino from AXA. So, yeah. Can you, Martin, can you stay here? Do you see the, because there is a preference here for,
yeah.
You don't, yeah, or you, but please have a look at this one.
Okay. Okay, thanks all. Yeah, sorry. I will talk today about the mirror descent algorithm for risk budgeting portfolio. This is a joint work with Nufel Frika and Adelred in Zettinghoff. Okay, so first of all, I want to give a brief introduction about the portfolio optimization. Like, classical portfolio optimization was developed by Markowitz in 1952. Its objective was, well, it was like the mean variance framework, and its objective was to maximize the expected returns. And there are risk constraints typically measured by variance. So generally we had this problem with an optimal portfolio W, its return is this one, and with this risk. What happens that it has its challenges and its limitations, especially its high sensitivity to estimation errors in expected returns, which made that we ended up with suboptimal portfolios. The same happened with the covariance matrices. Another problem is also the lack of explicit consideration of individual risk contribution. This is that we don't have a way to control how assets contribute to the overall risk. And the last one is the limited applicability in real world settings due to regulatory constraints, diversification goals, or maybe like our aversion to risk, these problems. This joined with the 2008 crisis and the dot-com crisis made like an interest in diversification and in risk management. Here it emerged the new paradigms such as the risk parity and its evolution, the risk budgeting, which is what we are going to talk about. So the concept of risk budgeting is like to build a portfolio where each asset contributes to total risk according to a predefined budget. What we will do, we will assign a risk budget to each asset. And then, well, it's important to note that we will, in our case, we will have a long only constraints. This is we cannot short sell, neither we cannot, we need non-negative weight, sorry. Okay, so then let's present the problem. We will be working with a financial market of the assets, and its returns will be given by a random variable x. The financial portfolio is made. It's denoted by U, which is the weight that lies on the simplex of the dimension, and the total loss is just the scalar product of both U and X in a negative with negative sign. So we will define the risk budgeting compatible risk measures as the one that have satisfy positive homogeneity and subadditivity, and with the following map. In a sense that the total risk is decomposed as the sum of risk contribution. As we can see, this is thanks to the positive homogeneity property joined with the Euler's homogeneity function theorem. Once pose this, okay, let's pose the problem. Then risk budgeting problem is we just going to equal the risk of each of asset Y, as we can see here, to up predetermined fraction of the total of the overall risk. That's the problem. We have questions like in our setting, do we have solution and it is unique? Yes, we have this theorem in which, like, given a vector of risk budgets B and a function defined, well, a function G which has to be continuously differentiable, convex, and increasing, defining this gamma G function, we have the result that there exists a unique minimizer, and the solution, indeed, for the risk budgeting problem is the normalization of this Y star. Okay, so what we will try to do, we will try to solve the problem of this minimizing this gamma G function in the Y variable. What we will use as risk measures? Well, generally, we have been using measures such as volatility, but our interest is in, we will be focusing especially on expected shortfall, which is the expectation of the losses in the 1 minus alpha worst cases. As we can see, we define it also with another risk measure called value at risk, which is the threshold between the alpha best cases and the 1 minus alpha worst cases. This is important because to solve our problem of risk budgeting with expected shortfall, we can use parametric distributions, or as in our case, we will be using this formula thanks to Rockefeller and UNICEF, in which we can calculate the expected shortfall, but at the same time, we can calculate the value at risk, which is the arc mean of the sheet. So our arc mean will be actually the value at risk at the same time. Okay, so what happens? How we generally solve this problem? Okay, at first, like the first attempts to solve this problem was like a normal gradient descent or a stochastic gradient descent, but they have some problems. The problem is that the gradient of the gamma G function diverges on the frontier of R0 plus D. Why? Because we have this log, so when we approach to 0, it diverges. The same things happen that we are working in a set in RD and not in our specific set that is R0 plus D. Therefore, we need a projection technique and a fine-tuning of the learning sequence. Okay, to overcome these difficulties, what we have done, first of all, for the first difficulty, we have worked with a tamed version of the gradient. This is the kappa of y, which is the minimum of the y's, and then we take the maximum of 1 to overcome also the case in which the minimum of the y's is 0. And for the second difficulty, we have used indeed the mirror descent algorithm. We have made another variation, is that indeed we are working, as we can see, we are working in R0 plus D, but we intersect with a ball of radius M. Why? We will see this is because when we are later searching for convergence and some results, we need a closed set and compact, so that's why we take a ball of radius M. So the actualization process then is given by the following formula, where PM actually it's the proximal mapping, and DF is the Bregman divergence, the so-called Bregman divergence, where F we will be taking as a function the negative entropy functions. Once solved, we obtain the following result. As we can see, if we are outside of our ball M, we have to project inside. If not, it's a conventional mirror descent algorithm. For the theorem of convergence, what we have then to choose? It's important to choose an M because, well, we will define our M. Therefore, we will choose an M big enough, bigger than the norm of Y star, in order that, and so taking a learning sequence that is diverges in the normal case and its square is convergent, then it will then we have assured the convergence of the weighted average especially, and we have also the following result. So yeah, the importance here is like to take a proper M, as we will see. But it's also important to know that we don't know the norm of Y star, obviously, but we have some guesses, and well, later we will discuss about this. Okay, what happens also? In some cases, we don't know neither the gradient of gamma g. Therefore, we have proposed also a stochastic version of this algorithm. As we can see, the stochastic version is the same. For the g function, we only change and minimize under a g with a convex loss function L, and rewriting the risk budgeting problem in the following way with an h function. Here, under my assumption, the problem admits a unique solution and characterizes explicitly the risk budgeting portfolio. Once solved, well, we have another time the proximal mapping P, but in this case we have a new Bregman divergence G, which is like a joint Bregman divergence within the G and our past Bregman divergence of the F. And well, the algorithm lies here. It lies also in R and R0 plus intersected with our ball. Yes, we can see here this is the solution. And the theorem is another time the same idea. We have to take an M big enough, and then we assure the convergence, and then we have also a bound. We can give out also some examples using for this stochastic framework for some special risk measures, well, from some risk budgeting compatible risk measures. Here we have worked with volatility, as we can see, is the following L. For expected shortfall is also this L. And we have worked also with some deviation measures, such as mean absolute deviation or the variantile at level alpha. Okay, let's work then with the numerical results, which is maybe the most important part of our work. So our portfolio, well, for the first results we have made was with 3 assets. We have choose from the S&P 500, JP Morgan, Pfizer, and Exxon. As I said before, our risk measure will be the expected shortfall of level alpha at 95%, and we will construct a equal risk contribution portfolio. This is we will beta 1/3 for every asset. We will use also a mixture of 2 multivariate student distribution. Why? Because we take the market as it has like two behaviors. One behavior more stress, let's say, and then one more normal behavior. So here we have the formula, and we did the calibration using like daily returns on the period of August 2008 to 2022 of April. Here are the results and the scale matrices. We can check them also, as well as the degrees of freedom that we have obtained for these assets. The risk budgeting portfolio we computed using some quasi-Newton algorithm, as we can see. The results were the following. So this is our benchmark. And for the DMD, our SMD calibration, after proving, we have taken for the DMD algorithm a gamma of n to the power of minus 0.55, 100 dm, and 50k iterations, while, as we can see later, the y star, the norm, will be 30. And important also, the initial point we have taken was 1/d sigma y squared in order to penalize the ones that have a bigger variance. This is the idea we had. For the SMD, we set gamma n to the power of minus 0.75, and we generate 10 to the power of 6 samples and 10 epochs. This will run 10 times this 10 to the power of 6 samples, initializing x to 0 and y as before. So these are the results. As we can see, they are pretty nice compared to the ones we have here. They're almost the same. We have also the relative error for both SMD and DMD. As I said, here we didn't calculate the expected shortfall. We just calculate the value at risk, because, as I said, it's the G. We can calculate both things at the same time. So we just wrote the value at risk. Important. Well, here we can see, especially in the low part, we see the convergence of the SMD algorithm. We can see the use, the Y's. This is the use is the normalization of the Y's wise and also the convergence of the value at risk. And on top, important, we can see the deterministic case. We have taken to show what happens if we put bigger gammas. For example, as we can see, the middle is our case, the convergence. It converges in around 2,000 iterations. While if we take a bigger gamma of n to the power of minus 0.75, the convergence is way slower, as we can see. What happens? We have also tried to work with a constant gamma of 1. I know we didn't develop this in the theoretical framework, but as we have tried, it's the one that provides the best convergence. Indeed, it converges like way faster in around 2,000 iterations for this case. But generally, it's the best way for the deterministic case. Also, as I said before, the importance of the parameter m, because we need to assure that the algorithm lives in our ball. This is very important. So what happens? As we have said before, if we take a small m, for example, of 10, as we had said that the y star, the norm of y star is around 30, then it will not converge. Our algorithm will diverge. But for the case of M35, 100, and 1000, we can see the convergence happens. So what is important then? As soon as we don't interfere with our numerical calculation, this is if we don't have a very big cost for the calculation, we should try to pick the biggest m as possible. Also note that generally for the cases we have tried, the convergence was generally around 30. So yeah, generally taking a m around 100 or 1000 will work, and I think it will always work. So what happens also? We have analyzed the case in which we have taken also a bigger quantity of assets taken randomly. So as we can see, we calculate the mean deviation error that we define in this way, and we run another time the algorithm, the DMD and both SMD with the same characteristics as before. As we can see, the errors are pretty nice because they are scaled by 10 to the power of 3. This is important to know. Also, the value at risk works seems pretty nice. Important also, we have compared the SMD to other benchmarks. Like we have for example, we have proposed the classical SGD, as we said before, that has these issues we commented. We chose this proposed by Fermanian, and we have also worked with a time version of it, of the classical one. So we define it as this. It's the same, but just taking our kappa modification. And what it happens, very interesting, that for the case, obviously, as we said before, the regular classical SGD, it diverges a lot of times, as we can see. This is taking the threshold, or the difference, sorry. This is if the bend of the epsilon we are taking, but generally there's always divergence. But for both cases of time SGD and SMD, there wasn't divergence at all. We can assure always convergence. After this, we compare the SMD with the time SGD, and we obtain this result. As we can see, our SMD converges quite faster, at least compared to our benchmark of the time SGD. Finally, we have also, well, here we can see the errors, like in a more numerical way. It's the same idea. And finally, I want to highlight also, because we have worked with another risk measures. As I have said before in the other examples part, we have also proposed a convex loss function that works for our algorithm, and we can work with the mean absolute deviation, volatility, and variant time. In the three cases, both SMD and time SGD work, but as we can see, our SMD works quite better, especially when we in almost all cases. Important to highlight, I didn't highlight this before, but it's interesting to note the difference of SMD and time SGD in the case of the expected shortfall when we take bigger quantity of assets. The difference in errors is quite notable. So yeah, to wrap up, like we have developed a mirror descent algorithm for risk budgeting portfolios, and the benchmarks we have used, at least we have seen that it's pretty interesting how it works against its rival, let's say. Thank you.
Thank you very much, Martin. So you want to make the discussion now? No, it's better maybe, directly if you can. That's okay for you, or you prefer to do both of them at the end?
I can do whatever you want.
No, I think it's better that the paper is fresh in the mind of everyone. Can we go to the discussion by Thomas Raffino? Not this one. Is it possible? That's your discussion? Okay, great. So come on, if you can look this way. Thank you very much.
So I want to apologize in advance. I'm not an academic, so it can be quite different from what you are used to see. So Martin just summarized his paper, so I will start the discussion with begging for help. Because I know that there is the author of the paper, but in practice, there is something that I really don't like with equal risk contribution portfolio is the issue of duplication. Here we estimate a portfolio with bonds and equity during a period where bonds were quite volatile. So we finish with a portfolio weight, I don't know, 60-40, around 60-40. And if you duplicate bonds, it could be, for instance, you invest in US and European bonds. At the end, the weight, as an investor, I would like the weights to be almost the same. And what we see is that the weight drastically change. Now we have a 50-50 portfolio. So there is a way to tackle this kind of issue, mainly working on based on the work of Herbert Simon, with a Nobel Prize in Economy and a Turing Award laureate, that demonstrate that we have to take into account hierarchy when we try to model complex dynamic markets like financial markets. So there is work with where we use clustering, like what you've done, Lopez de Prado or me in the paper. But what I would like to do, and I'm not skilled enough, is to create a global optimization problem that tackles Markowitz, equal risk contribution, and that takes into account the hierarchy approach. And I've never seen that in any paper, so I'm begging for help because I did not manage to do it. So, but back to the paper, I was surprised not to see any reference to Palomar. Palomar is working on signal processing, so he's not a finance guy, but he's reading a lot on portfolio optimization, sparse index tracking, and risk budgeting. So the two books that I quote here are quite interesting, and it can be something that you can add to your paper to see the comparisons with your approach. Another approach that I was surprised not to see is the genetic approach that is sometimes used to solve this kind of problem. And if I have to admit, in my team, in AXIM, we only use a genetic approach for everything we do in portfolio optimization. So I would like to see the references, the difference between your approach and the genetic approach. And about the paper, you use 250 assets. Is not enough for investors. I would like to see, I don't know, 500s, like the S&P 500s, just to see the impact if the size of the investment universe increases. And another issue that I sometimes face with optimization is when the investment universe is non-homogeneous. You have worked with stocks and only stocks. So what if you have stocks, bonds, and things like that, and you try to work on that? It can be sometimes more complex. And at least you sample a lot of data, I don't remember the exact number, but it was quite a lot. And I would like to see the impact of the length of your historical data. Does it have some value, or can you change it, or what the impact of this kind of parameter? And yes, that's all for me.
Thank you very much, Thomas. You want to answer, Martin, or make some comment?
Okay, thank you so much for taking the time reading the paper. Oh, yes, sorry. Yeah, I would like to thank you for your reference about the Palomar and genetic approach. We will take this into account and read and see if we can incorporate somehow this into the paper. About the more assets, we have tried with 500 assets. Yeah, it works, but it's true that as soon as we increase the quantity of assets, for every algorithm, it's difficult. Although to the other benchmarks we have compared, it works pretty nice. And the non-homogeneous investment universe is also another thing we need to work in it. Finally, about the impact of the length, yes, it's true. We have taken. I also think we have taken a lot of assets. Sorry, of data. This we did it in order to show the convergence, like that it was pretty nice. But yeah, we have also tried with a lot less quantity of data, and it still works. Maybe you have to put a bigger quantity of epochs, for example. But yeah, we have worked with it. And for example, I think 10 to the power 3, 10 to the power 4, for sure even less, it still work. I mean, maybe the convergence is not as spectacular as in the case of 10 to the power of 6, but it still works. Because as you can see, also in the example of the chart when we compared with TimeSGD, the convergence was pretty fast, and it's like the characteristic of this approach, let's say, to the problem. Thank you.
Thank you. I think there is time for a question or two. No comment? No. Okay. So maybe later or no. Okay. So we have time to move on to the next presentation from Nicolas Baradel from École Polytechnique. So edging option with a neural network optimized with a control variate. So Nicolas, yeah. So this is the mic. If you can look at this screen so that they can see you on the camera, right? So it's better if you, yeah. Thank you. So
Okay,
you have 20 minutes for the presentation.
Okay, thank you very much. So first I want to thank the Fondation Natixis, which supports this work, and in particular Michel Crouy, Denis Teiletche, and Olivier Croissant. And what I present today is based on a work in progress, so every comment is welcome, of course. So the objective is very classic in quantitative finance. It will be pricing and engine derivative options. And we will work with a single network, and so it will be with a neural network. The aim is that the network will provide at the same time the price and the edge, and we will see which form. And an objective also is to deliver an easily and usable code. So the idea is that at the end the code will be open source and easy to use, to price and to hedge every option in the case of, when it works, of course. It's not always the case. And the assumption will be that we have a Markovian model, but we will fix an example, a complete example later, but for the framework, we just need to be Markovian. And in order to have the inputs inside, of course, the neural network. and in a perfect market, so in particular, no transaction costs. So what we will use later, it will be the well-known self-financing condition, which means that you start from a value, you gain the risk-free rate for the cash you still hold, and you get also the variation when you invest. Here with the notation, Z is a vector of assets, so we may have 2 or 3 assets inside. Delta is the strategy, so later it will be the hedging strategy. And V is the value of the portfolio, and you can write these in this way when there is no transaction costs. So in a complete market and perfect market like here, if you want to hedge an option, say that it is with this payoff G of Z here, we know that we can start, if P is the price of the option, we know that we can start from this price. We get the hedge from the derivative, so the gradient of the price of the option. And if we follow this strategy continuously, at the end, we will have the payoff, and so we perfectly replicate and hedge that. And the idea will be to use this with an OR network, so it will be to replace the price and its gradient by an OR network and the gradient of the neural network associated to the underlying. And in an incomplete market, we will see later. So later, the idea, I repeat it, the neural network will represent the price, and its gradient will represent the edge, the hedging strategy. So what does it mean? It means that because we will hedge in discrete time, and for the example later, the delta T will be daily, so it will be a rebalance of the portfolio every day. And so the aim is the objective is the following: is that when you start from the value here and theta of TZT, which will represent the price of the option, and when you apply the hedging strategy, here it's general, but just say with no interest rate there, it's easier to read. And when you invest the gradient of the neural network, at the end, you should have the new price of the option at the next time, and the next time step. And our context, we will rebalance the portfolio after delta T. So in the example, it will be daily. And we will see in an incomplete market. So 2 reasons for that. We will not have a perfect edge at the end, of course. The perfect edge cannot exist in this case, and the idea is to have the best one possible. So we establish an example of a Markovian incomplete market. So I describe quickly the model, and I will provide just after the processes. So we will work with a market in which there is one underlying asset, and it will have a stochastic volatility. So it will be a stochastic volatility model, and the stochastic volatility will be correlated with the underlying, and this correlation will be itself stochastic. So what we will have 3 randomness. 3 sources of randomness, and we will provide 2 assets. The first one will be, of course, the underlying, and the second one will be an asset which will be related to the stochastic volatility. And we will use a highly liquid vanilla option there. So it will incomplete in the fact that you have 2 assets, and there are 3 sources of randomness. And of course, since, as usual, we are in discrete time, so it will add an additional error. So what is the model? The model starts classically here. So this is an example as the framework should work also with other models that are Markovian. So X is a process with an exponential form. As you see, it looks like Black-Scholes except the stochastic volatility. After the stochastic volatility is a mean reversed process, so it's mean reverting to this sigma 0 here, and it also have a noise here with a term at some power gamma between 1/2, which is the Cox-Singer-Zorros process, and 1, which is a linear case. And this thing there, it's just here to say that this Brownian motion is correlated to this one with the coefficient rho. And rho, as I said, is stochastic itself, and rho is defined through process P, and this process P is defined by itself, and this one just follow also a mean reverting process here. And this P is not in -1, 1, and actually the correlation is P through the tangent hyperbolic function. So the main idea is just we have a model. There is 3 randomnesses, and we will try to edge it with an option with 2 assets. As said, perfect edging is non-stable for 2 key reasons. The first one is that the market is incomplete, as I said, and the second one, I also said it before, we are in discrete time. And so what will be the objective? It will be to minimize the edging error between consecutive dates. So I will provide the full loss later. And using the self-financing equation in which you saw that there is a price with the neural network value and the edge with its gradient. And for the validation, we will look at the Black-Scholes formula because it's easy to have one for several options, different options. So I talk about the market. Now I will be more precise about the assets on the market in order to hedge the option. We will have 2, as I said, the underlying and a liquid vanilla option. And here we will need an assumption how the price of the option evolves according to the evolution of the stochastic volatility. And just for the example, we say that it will be the Black-Scholes price with the spot volatility. So the option will be the price of C, which is the option not to cover the option that we will use to cover our option. Sorry for the different option. I mean this asset C will be priced with Black-Scholes formula, in which we'll place the current spot volatility. And this will be an asset that we will use in order to hedge our option. So what will be the network? Generally, the network, we will ask it to hedge a terminal condition G here, which depend on the underlying, and we will give 3 parameters. For example, if it is an European option, it is just the strike price. If it is a binary option, it is just the level of the barrier, and so on. And the neural network, we have the simple form. Here you have the time to maturity, so the time inside. You have the edge, the assets that you can use to edge, so X and C, and also the different parameter. Here K is the parameter of the edge. You can give also, you can make your network free with the parameter of the edge. So your network can provide you the edge for different vanilla option. And the derivative, so the gradient, the partial derivative with respect to x will be the edge with the underlying, and the derivative, the partial derivative with respect to c will be the edge for the second asset, which is this call option that I introduced. So this will be the errors, so the criteria we will optimize. The first one will be the criteria associated to the pi, so we will simulate a huge number of paths, and so this will be E equal to from 1 to n, and we will also simulate it in discrete time using Euler scheme, for example. And this is the j equal to 0, from 0, sorry, to m minus 1. And here, it's just the self-financing condition which is written. You start from this price. You apply, here it's written with r is equal to 0. You start from this price. You apply your edge, and it should be close to the new price at the date later. So here it's g. Here you have the evolution with your edge, and you should be close to the price associated with tj plus 1. And here the delta, of course, are the derivative of the neural network itself. So as you can see, in this equation, you have both n theta and its gradient. And so when we will optimize, when we will minimize it, it should, if it works, it should optimize on both parts at the same time. So we should have a good price and a good edge at the end. And of course, you also add a penalization for the terminal condition. And this is simple. We just look at some point at the end, and we check that we are close or not to the payoff. And the final criteria is just the sum of both loss with a weighting factor, as usual, between both. So we will start with a straightforward case, which is the easiest one. If it doesn't work for an European call option, we should stop. So here I present the case of a European call option that will try to hedge in this incomplete market. So not that I know the second asset is also an European call option, but the assumption is that it follows some price associated with Black-Scholes. Here we want to price and hedge this one in the incomplete market and to be good on it. So the first result using this directly. Here what we do? We compute here the P&L of the hedging strategy given by the neural network and the Black-Scholes formula, but with the model, incomplete model that I presented before. So what it is here, the dark line here is the P&L associated to Black-Scholes hedge starting from the Black-Scholes price. So of course, it cannot be perfect. We are in discrete time, and also Black-Scholes ignores the stochastic volatility and so on. And what is the gray area? The gray area is the same P&L, but computed starting from the price from the neural network and the edge given by the neural network looking at its gradient. The first thing that we can see, it works and it doesn't work. Why? Because because we are close to Black-Scholes, and Black-Scholes is not completely wrong. It's not right, but I mean it edges something. So we are not so far away, but we are not better. And we know we should be better because even if you are in a complete market, we have a second asset that should help us to hedge the option. So there is no reason that we do not beat it, but even by changing a lot of parameters, it's difficult to be strongly better than Black-Scholes here. So what we can do? Here, if we look deeper of the result we have and the behavior of the neural network, we saw that the terminal condition actually, even if it is continuous, it is not so easy for the neural network to satisfy it perfectly. I mean this minimization here. Because here we have the payoff of the collapsion, European collapsion, and the neural network is completely regular, C infini and so on. And here, the terminal condition is not derivable at this point. I mean, you know. And so it's difficult. And the first idea is to help the neural network on this stage. So what we, it's after that I tell you what we do. And the second one is some arbitrage-free conditions are not perfectly satisfied. I mean almost, but not perfectly. And you know for the European options, there is a bound which is exactly the intrinsic value when R is equal to 0. And sometimes far away from a little bit far away from the money in both sides, we can be a little bit lower, so we can also put it in the loss in some way. But the most important thing will be the first one. So what we do, we provide a new network, which is not a... So we introduce a new network, the green one, which will, the blue one is still a neural network, but the green one will not be a true neural network. It will be the neural network in blue plus this function f. And we will ask to this function f to be equal to the payoff at the terminal date, which is 0 because it's time to maturity. And in this case, if I am at capital T, to verify G here for the green function, it will be done only if the blue one, the true neural network, is equal to 0. So it will be query easier. And to ensure, what we can do, what we can use as a f function, it's simply to use Black-Scholes formula, because Black-Scholes formula is perfectly regular before the terminal date, and at the terminal date it is the payoff, so it's a natural candidate for that. And quickly, this one is not important, we skip it. And quickly here we have clearly better results. So we can see that the distribution of the PLN is clearly more concentrated, close to 0, using that. And yes, it's difficult to know how better we can do, but here it's clear we are better. And just to conclude, yes, the only problem here is that you have to define your own function. It's not, it's Taylor-Made now, so you need to define the function f, but actually it's not complicated in practice. And final example, and it's over. For the binary option, so now it's more difficult because the payoff is not continuous. And as you know, the gradient of associated to the edge goes to infinity. And since it's still a work in progress, we will see that it doesn't work. And here it's just to show quickly that even if it is discontinuous, the gray line is the value of the option of the neural network at the payoff. And with our trick, you see that it is very easy at the terminal date to satisfy the function G. And here is the price, but the edge there, I would prefer Black-Scholes because Black-Scholes is orange and the network is the blue one. So it's not clear that if that we can do it for discontinuous payoff. And as said, it's still a work in progress. Thank you very much.
Thank you very much, Nicolas. The discussion will be done by Thomas Raffino again.
So yes, it was very difficult for me because it is still work in progress and the article is far from being finished. And I've never worked on edging, so I will focus on what I know. It's neural network. And in your paper, you say I take a 3-layer neural network, and I don't know why, and I'm not sure it's the best choice. So I want to dig into this option. I steal these slides from Dixon, Matthew Dixon, who used to be an academic and now a rock star, but it used to be a mathematician, academician. And the impact on the neural network architectures. So it's easy data sets where called half moon. And in the first case, what we do is we add hidden layer. So 1 hidden layer, 2 hidden layer, as in your paper. And what we see is that we still do not manage to estimate the function quite nicely. And the second option is to keep only 1 hidden layer, but to add neurons or units, as you want to call them. And you can see that when you increase the hidden units, it works far better. In fact, one option for the paper will be, if there is a difficulty with the neural network, is not to add hidden layer. In fact, it's to lower the number of hidden layers and to add more units. It could work far better for your problem. And it leads to the new hype subject on finance and on neural network, which is the double descent. In fact, what the author have shown is that you can overtrain your training sample, and then you manage to, in contrary with the traditional bias variance framework, you can be able to extrapolate quite nicely on unseen data. There is a paper published by Kelly, which is on Journal of Finance, which is called The Virtue of Complexity on that. I have to admit that I tried to replicate this article, and I know that some colleagues try to replicate this article and they do not manage to do it. In fact, what I've found is it doesn't work. I've tried, they use, in fact, what you want to do with double descent, it's you want to over-parameterize your networks. You have 2 options. One is with features. So in the virtue of complexity, they use random features, random Fourier features, and they add many, many features. So I try with their data set and I try with other data set, and I did not manage to make it work. And the other option is to add many units, like Matthew Dixon did in his article, but when I say many, it's really many more. And what we can see is, if we look at the geometric complexity of the network estimated by the Dirichlet energy, it increases a lot, and then when you are very over-parameterized, it starts to decrease, and the network starts to be very smooth. So it works quite well in practice from the cases I've done and from a presentation I've seen by Aspect, the hedge fund, where they use it in practice.
Thank you very much, Thomas. No, you're not finished?
Oh yes, I don't know about hedging, so I have no...
No, that's
no
perfect. Thank you
on
very
that.
much. Thank you for your comment. Nicolas, if you want to answer or mention? Any comment yourself?
Just thank you for the comments.
Okay, thank you. Any question Yeah, Raphael, I'm coming.
Thank you. I wanted to know, when you make comparison, in this context of what happens when you are in a very, heteroscedastic context as we are in practice. So this is, one of the big difficulties of Black-Scholes delta hedging, even for very vanilla options. So do you have a progress in using neural network to adapt to the heteroscedasticity of markets?
Sorry, I didn't understand the beginning.
Your comparison of using neural networks versus Black-Scholes.
Yes.
Now you put it in real situation when, for instance, Black-Scholes, the way traders apply Black-Scholes, they essentially use the implied volatility, which changes all the time.
Yes.
So my question is, how does that compare, and what are the kind of improvement that you can expect using neural networks in delta hedging in a context where the volatility is changing all the time?
Yes, we still not have used the real data. It's an objective at the end, of course. And in this case, the idea it was just sorry. Yes. And in this case, it was just to use a second asset, which is linked directly to the volatility. We just did an assumption to do it with Black-Scholes formula, but I think it's, of course, in practice, it's not what we will use, but it should not be a huge problem since it is linked to the volatility. And I think, yes, it should work, and we will check it at the end with another, a true evolution, when it really depends on the hidden process we use, the stochastic volatility as a true randomness.
Yeah, a small question about your notion of price. So your price is something which minimizes a risk criterion. So it's not a risk neutral price. It's just you find it as minimizing your square, and you get the price from here. You don't start from the fact that there is no arbitrage in the market and you have something which is arbitrage free. So, and then at the end you compare with some arbitrage free price, which is Black-Scholes. So in a sense, it's not so strange that the two prices doesn't coincide because they are not coming from the same kind of criteria. So you are in an incomplete market, the price should be the super replication price. So it should be the supremum over all the martingale measure of the expectation of your final payoff. But as you say, there may be some arbitrage in your neural network representation. So I just wanted to be sure that your notion of price is really something which comes from the minimization of your risk criterion.
Yes, the price here is the one that minimizes the hedging error from the beginning to the end, not looking if we have a better edge or lower edge than if we mean we make money at the end or not with following this strategy. And yes, what we observe for the call options, the price is very close to the Black-Scholes ones. If you place yourself at the, for the volatility at the long-term one, but after we have sometimes some deviation from the arbitrage-free condition because we did not check it before. But it's very small. In practice, the weight is very, very low. If you place a weight which is very low compared to the other, you directly go above easily.
Last question.
Just a quick remark regarding the hedging of the digital. Since you can replicate the digital with the call spread and you know how to hedge the call, maybe you can compare, you can come up with a hedge, for the digital, given the decomposition of the digital in terms of call spread and knowing the hedge of each call of the call spread.
Yes,
it could be interesting to compare. Yeah.
Yes, I agree. Actually, it's the next step here because for example, Thomas did not have the last slide with the binary option, and I just performed it last week. So yes, it's something we have to look.
Thank you very much. Thank you to all the presenter and the discussants. So I think it's time to close this session and to go directly to the cocktail session. So thank you very much. Merci.